Hello, good day, everyone. My name is Dr. Obafemi Oyomi, and I welcome you back to my YouTube channel. Today, we're discussing taxation. We're looking at taxation, and the topic basically is basis of tax assessment. Basis of tax assessment. And let me just quickly share my screen so that you can be part of the program fully. Okay, so if you are joining this particular channel for the first time, I would like you to subscribe. And I believe that once you do that, you're able to have a good understanding of whatever courses that will be loaded, in the future on this particular channel. So quickly, let me just share my screen for everybody to see. Just a moment. Okay, just a moment for us to see. So taxation, theory, and management. We're looking at basis of tax assessment. Now, when it comes to accounting, there are we have to talk about basis of tax assessment. And then we're talking about taxation here right now. So we're looking at basis of tax assessment. So let's continue. Now, when it comes to accounting, there are periods that we have to consider. Okay, we're talking about some concepts that are related to periods. The first one has to do with going concern. We know that one of the concepts in accounting is going concern concept. And this talks about the fact that a company or an entity, once it's established, is expected to live forever. So it's supposed to be a going concern until anything happens to it that it does, face to exist, at a particular in the future date. But of course, it's expected that every company lives forever. It's an individual, as it were. So it's expected that it lives, forever, even surpasses the owners, the lives or the lifespan of the owners. Okay. So let's look at periodicity. And a bit for us to account, to account for all the different transactions, to report on the state of affairs of the company. It is expected that this period, this going concern, is broken down to different periods. Different periods. It could be monthly, it could be yearly, it could be quarterly. So that talks about periodicity. Usually it is per annum. That's a 12-month calendar. Now let's look at accounting periods right now. An accounting period is a time frame used by a business entity to prepare its financial statements and reports about its financial position and performance to relevant stakeholders. So we're saying that when it talks about accounting period, we're looking at a time frame, okay, usually a year, used by a business entity to prepare its account. So every company is expected to report, its financial statement, and activities per in a particular period, specific period. An accounting period is also referred to financial period. It's defined period during which business records its financial transaction. Though an accounting period or reporting period is often 12 months, it could also be a period of 3, 6, or 12 months. The International Financial Reporting Standards, IFRS, allows a 52-week period, also known as the fiscal year, instead of the full year as the accounting period. Let's continue with our discussion as we talk about, basis period. Basis period. A basis period is the accounting period for calculating the accessible profit. It could either be a preceding or actual year basis. What this is talking about is the fact that when we want to calculate the tax to be assessed, the profit to be assessed to tax, we use what is called basis period. And this basis period has to do with the time frame now, the accounting period for calculating the assessable profit for the company that's going to be assessed to tax. A preceding year basis means that the assessable profit of the previous 12 months accounting period has been subjected to income tax. So existing companies in Nigeria is expected that they use preceding year basis for the purpose of arriving as the tax to be calculated for them. Okay. On the other hand, actual year basis is when assessable profits from January to December, for example, within one calendar year are subject to income tax. All right. A new company may have an abnormal basis period for filing its first tax returns. This arises if the accounting period for computing income tax liability is greater or less than 12. So when the company is starting afresh, it's better for it to report its own account, okay, depending on the time that you start the business. All right. So when the business is started, whether it's in 9 months or 12 or 9 months usually, or maybe 6 months, or maybe 7 months, it's expected that there will be a period that could be an overlap, or that could be a different from the regular 12-month calendar that we're talking about. All right. So let's look at calculation of company's income tax. Calculation of company's income tax. An entity's profit is usually ascertained after matching the income against direct costs and the expenses reported in financial statement. That's where matching concept comes into play. So usually for an entity, its profit is determined or ascertained after matching the income against direct costs and other expenses that are incurred for the purpose of generating the income of that particular company. So first, the accounting profits will be adjusted to arrive at the profits for tax purposes. These adjustments are made to accounting profits in order to arrive at the taxable profit. So what you're saying here is that usually when it comes to taxation, it is not the profit that's being reported, ab initio by each company that will be subjected to tax. There will be an adjustment that just in order for the actual profits to be taxed, by the relevant authorities. And we're saying here that expenses must for an expense to be recognized as allowable expense, it must be wholly reasonable and exclusively and necessarily, incurred in generating the income of the business for a particular tax year. What it means that for you to recognize an expense as a tax deductible expense, it must be wholly. So that means that the totality must be, put there. That's where again the matching concepts comes in. Wholly, reasonably. We're talking about reasonable. When is it reasonable? Okay, you can't say that you're spending 5 million naira to generate an income of maybe of another 5 million naira. So it means that is it reasonable? Okay, that's talking about reasonability. Okay, when we talk about exclusive, it means that it is exclusively generated and killed for the purpose of that particular, for the purpose of generating the income of the company for that particular year, exclusively, incurred, and then necessarily, it must be necessarily incurred. That means that if this particular cost is not incurred, then the revenue will not be generated. So that's why we talk about RWR. We're talking about wholly, reasonably, exclusively, and necessarily incurred. Okay, so let's look at commencement rules. The commencement rules relate to how the taxable profits of an entity will be calculated for the first 3 years. So when the company is starting its business, commencement rules apply. Commencement rules apply. So it means that when that particular company has started, there will be a standard rule that has to be applied in order for the company to be assessed to tax. Okay, in the past, before the Finance Act of 2019, the commencement rule was applied thus. So the first year, the date of commencement of the business to 31st December of the same year. A second year, the first 12 months from the date of commencement. And then the third year, 12 months accounting period ended in the preceding year of assessment. So that has been the rule, in the time past. So new companies in Nigeria are expected to file their tax their first set of tax returns in line with the commencement rules. So let's go and look at let's have a vivid explanation or illustration to what we just said earlier. So we're looking at this case, this scenario. Company XYZ commenced business in Nigeria on the 1st of September 2015. The first account for the 15 months ended on 30th November 2016. So this is the scenario we are faced with now. A company that started business on the first day of September 2015. If you're going to apply the commencement rule, okay, the commencement rule, it means that the basis period they're going to use, the accounting period they're going to use for the purpose of generating or accounting or adjusting, the income to be assessed, to be assessed to tax will be as follows. So for the first year of assessment, it's going to be 2015. It started business in 2015. So the first year of assessment is 2015. So it starts in this one now is saying that the basis period will start from on the 1st of September 2015 to 31st December 2015. All right. So again, second year is saying that's for 2016. for 2016, you have 1st of September. We are talking about the first 12 months now. 1st of September 2015 up till 31st August 2016. Okay, and then for the third year of assessment, that's 2017, we're going to start from 01. That's the first day of the new year of the year 2015, and then it's also ending here 38 to up to 38 November 2016. So that will be the accounting, the different bases that will be used in order for this particular new company to be assessed to tax. So the due date of filing for the first year is 18 months. Usually it's 18 months after the commencement of the business, or 6 months after the accounting year end, whichever is earlier. So thus, for 2015, the tax returns will be due to be filed on the 31st day of May 2016. So let's look at the Finance Act, what it has brought into the fore. Now, the Finance Act 2019 has changed this tax narrative. New companies with effect from 13th January 2020 can now file their corporate tax returns on a preceding year basis. So now there is no dichotomy, there is no separation between a new company and a company that has been in existence before now. So in effect, the existing and new businesses will be, we have the same basis of taxation. That is the preceding year basis. So for the first year, the basis period starts from the date of the commencement of business to the accounting year end. The second year end, the other years will be a 12-month accounting period ending in the preceding year of assessment. That is the income, the profits and income for an accounting year will be subjected to tax, okay, in the next year of assessment. So in this case, there is no more overlap. The previous year, we'll talk about, the previous system, we have an overlap even from the very beginning. Overlap this particular period ending here, overlap, there's another, there's an overlap here. Okay, 01, 09, 2015, we've already accounted a part of it here. So we are starting again, so there's an overlap. So what this one, talks about is the fact that companies are being subjected to tax unnecessarily. One particular income is subjected to tax about 2 times. So that's why the Finance Act, was actually brought to the fore in order for such errors to be corrected, as it were. Okay, so let's look at the example that we have to consider here. A company or an enterprise commences business on 1st July 2020 and makes its account up to 30th September 2020 and subsequent years. So for a company that's starts its business, started on the 1st of July 2020 and makes up its account up to 30th September 2020. Now let's look at the basis periods and the year of assessment. So for the first year of assessment, okay, the basis period is the date of commencement, 1st of July 2020 to 30th, the end of the year, reporting year. Okay, so that's what we have there. Then for the second year of assessment, now it is no longer going to be, there won't be any overlap any longer. So it's starting from 01, that's October, 1st day of October 2020 to 30th September 2021. That's for 2022 year of assessment. And then for 2023 year of assessment, we're going to be looking at 1st day of October 2021 to 38th day of September 2022. So you can see that in this case now, there's no more overlap. So that's what this Finance Act has come to correct. You can see the difference between the old one this time around, and there's no overlap at all. So let's look at adjusted profit. There's a concept that you have to understand, for the purpose of actually calculating assessable tax. Tax that will be paid by each company. The first one is adjusted profit. The second one is assessable profit, and then the last one is taxable profit. Okay, so adjusted profit of an entity is computed after adding back disallowable expenses and deducting allowable expenses and incomes exempted. All right. So what you're saying here in this particular case is the fact that yes, once you have your net profit before tax now, the net profit before tax will have to be adjusted. Some expenses will have to be added back. Those are expenses are called disallowable expenses. They are not allowed, for the purpose of computing tax. All right, that is a disallowed. So, for example, you have depreciation. Okay, you have to add it back. Okay, you have to add it back. You also have some costs, maybe problems of fines, maybe penalties, and all of that. They are not permitted to be carried as the expense, or expenses of the company. So what do? You have to add back all those expenses that are disallowed for the purpose of computing the tax. All right. So if there is no tax adjustment to the financial statement, then the assessable profit is equal to the net profit. Nevertheless, expenses such as penalties, fine, and depreciation are not allowed in the calculation of income tax. Okay, in essence, the salary expenses are added back to the profit, to the accounting profit, which will now increase the assessable profit. Let's look at the example, a vivid description here. Calculation of adjusted profit for the year ended 20xs. Okay, so net profit as per loss, net profit as per profit and loss. Okay, so we are coming from an income statement angle right now. Okay, so the net profit that you have, computed over, the course of the year or for the particular year will now be brought here as the figure to be used. Then you also add disallowed expenses, okay, like some of them we are given earlier on, okay, depreciation and all whatnot, okay. Then you want to deduct expenses, okay. You want to deduct expenses that are liable, but of course probably have not been treated as such. So you're going to bring them here. Okay, maybe some incomes that are also exempted, as income that you that have been exempted will also have to be deducted from it. For example, when you carry out when you export, businesses abroad, or when you export some goods abroad, some of these items are not expected to be taxed. So some of these incomes are is deducted um, from your profit, as it were. So assessable profit, let's look at this one now. Assessable profit is computed by deducting unrelieved losses from the adjusted profit. That is before taking into consideration capital allowances, balancing allowances, or balancing charges. So we're saying here that I'll still explain this later on. But for the purpose of explaining at this particular point in time, assessable profit is computed by by deducting unrelieved losses, unrelieved losses. So the unrelieved losses, quickly, let me just explain that. You have a situation where maybe a new company or maybe it's a particular company has been in the business and then something probably happened and then they made a loss. It's not expected that that particular company will, suffer for it unduly. So such a loss will be carried forward, okay, to be taken from the profit, as it were, in the future. So that's why we talk about unrelieved, losses. Okay, we'll be taken away from that. So once you do that, we arrive at what is called as assessable profit. Now let's look at total profit. Total profit is the assessable profit minus capital allowances or relief in the year of assessment. Total profit is the assessable profit minus the capital allowances. So I'll explain capital allowance later on. A taxpayer can carry forward any unused balance in capital allowances for an indefinite period. Now, when we talk about capital allowances, these are allowances that are given, that are tax allowed. Allowances allowed by the tax law for a company to be taken out of the profit. Okay, so instead of depreciation, we talked about capital, allowance, capital allowance. So that's what we are talking about, here. So a taxpayer can carry forward an unused balance in the capital allowance for an indefinite period. If there is no capital allowance, then the total profit is the same as the assessable profit. The total profits arrive after deducting the balancing charge to the adjusted profit while subtracting the capital allowance accumulated loss brought forward. Okay, so let's go ahead to look at what capital allowance is all about. Capital allowance is an allowance granted to an entity or a taxpayer for incurring or using qualified capital expenditure during a year of assessment to derive its income. This is tax deductible. This is tax deductible. So we're saying that instead of you calculating depreciation based on normal accounting principles, okay, now the tax laws have allowed you to take an allowance out of your profit. So this allowance that is granted to a taxpayer for using a qualifying capital expenditure. So this basically they are not current assets, not current assets that are, qualifying to suffer or qualify to benefit from this allowance. Okay, capital allowance are granted to taxpayers on qualifying capital expenditures. So companies in the manufacturing and agro-allied sectors can claim the entire capital allowance in a tax year. So in other words, manufacturing and agro-allied businesses have no restrictions for capital allowance. So we're saying that for usually for regular businesses, apart from manufacturing and agro-allied, okay, all other companies will have to restrict, okay, their capital allowance, total capital allowance, to 62, 66, let me go back, 66.3%, 66.3%, okay, of the assessable profit in the year. So that means that for any other company that is operating in Nigeria, you are not allowed to claim the total allowances generated or given or allow the business in a particular accounting year. So it means that it has to be restricted, but this restriction is not for manufacturing or agro-allied sectors in Nigeria. Okay, so let's look at loss relief. So I've explained losses before. Loss relief is a type of assistance granted to an entity or taxpayer to reduce its tax burden by recovering losses incurred in a particular year of assessment from the subsequent year's profit. So the whole idea is to ensure that companies does not a particular company does not suffer unduly. If a company has made a loss, so that loss has to be allowed, for so that the person will not, the company rather now, will not be paying taxes out of capital, basically, because if you made a loss and you are requested to pay tax on the loss, it means that you're actually paying from your capital. Okay, so that is just what we're talking about. So let's look at the other angle that we talked about in calculating, assessable profit, balancing charge. Balancing charge is one of the elements of balancing adjustment, which is arrived at when an asset is disposed of. It may occur where the sales proceeds exceed the tax written down value at the time of disposal. Time written down value or tax written down value talks about the cost of the qualifying capital expenditure minus the capital allowances that have been written down. Capital allowances have been deducted over the years. Okay, so that's where you have your tax written down value at the point. So when the company now sells, that particular asset, so the tax written down value will be deducted from the sales process. And once that one is done, that's a balance. Okay, balancing charge here now, it means that a company has gained more or has is sold maybe let's talk about a company where a company sells that particular asset. It means and the value or the sales proceeds exceeds that written value. It means that at the end of the day, it has to um, add back the balance sheet. Then it becomes an income to the company. These are the tax rates in Nigeria. Okay, small companies will do 0%. Medium companies will do 20%, of that's what is tax rate that's allowed. So medium company will be any company that's generating income of 25 million and less than 200 million. For large companies that are generating over 100 million, the tax rate is 30%. So let's look at the chargeable income now. So we talk about adjusted profit brought down. We have calculated that before. Balancing allowances, adds back balancing charge. Okay, then you have your assessable profit, which as I mentioned earlier on, minus capital allowances, and then loss relief will give you chargeable profit. And then you apply the applicable tax rate on the value. That's what you have. So you have at tax liability. So we've come to the end of this particular class at this point in time. Thank you for joining. If you're yet to subscribe, please go ahead and do just that. And I trust that when else I load or upload any particular video, you have the benefit, you have the opportunity of benefiting from it. Thank you very much.